Welcome to the debate. Today, we are confronting what I believe is the most urgent structural threat to retirement stability in decades, the definitive end of the 40-year bond bull market. U.S. 10-year Treasury yields have surged. They've completely broken that long-term downtrend, and it's forcing a fundamental reassessment of how retirees hold fixed income.
And the central question is simple, but yeah, absolutely high stakes. Given this structural shift and, rising global instability, is the failure to urgently and aggressively diversify retirement portfolios into sophisticated alternatives like private credit and hard assets, is that a reckless path toward portfolio collapse? Or does that aggressive approach introduce unmanageable liquidity and credit risks for the average retiree?
Right, and I hold the position that complacency is now the true risk. Urgent, proactive diversification is essential to avoid disaster.
And I come at it from a different angle. While I fully acknowledge the seriousness of these structural bond concerns, the inversion we've seen is a historic alarm bell, no doubt. I firmly believe that the proposed urgent leap into complex, illiquid alternatives often introduces far greater and frankly less manageable risks for non-institutional investors. We need disciplined caution and transparency, not, fear-driven speculation.
Caution. In this market, I think that's a luxury we no longer possess. The data is screaming that this is a structural failure, not some cyclical correction. We are witnessing institutional behavior that confirms this. Look, foreign central banks bought a staggering 1,078 tons of gold in 2024. That signals a pivot away from dollar-denominated paper assets. Yet average retirees are frankly sleepwalking into disaster by clinging to high-duration fixed income. Traditional bonds are now caught in this vicious cycle. Rising yields, which adds approximately, $250 billion annually to U.S. interest costs for every 1% increase. They balloon the deficits, requiring more debt issuance, which in turn further increases yields. It's unsustainable.
Okay.
The proactive solution is already proven by sophisticated money, private credit. It has delivered superior, consistent annualized returns of 9.3% over the past decade. That significantly outpaces high-yield bonds at 5.9%. And critically, it achieves this efficiency with a compelling Sharpe ratio of 2.61.
Okay, I'm sorry, but I just don't buy the idea that institutional returns automatically translate to retail suitability. Let's start with your impressive Sharpe ratio of 2.61. For our audience, that means private credit has historically generated excellent returns for the amount of volatility or risk it takes on. That sounds great in a white paper, absolutely, but that performance comes at a severe cost for a retiree.
Which is?
Well, you highlight duration risk, the sensitivity of a bond's price to interest rate changes, which is indeed critical. I agree there. But we cannot simply replace that single quantifiable risk with two more insidious risks: illiquidity and opaque credit exposure. Private credit funds are inherently illiquid. We are talking about typical holding periods of, 3 to 7 years, sometimes longer. For a retiree who relies on dependable income or, might face an unforeseen medical expense, this constraint is a critical problem. It's a problem that standard fixed income, especially short-duration bonds you can hold to maturity, simply does not pose.
But that inability to liquidate is exactly the premium you are paid for. It's the compensation for having a long-term horizon. But let's address the core criticism head-on: credit risk. You say it's opaque? That risk is demonstrably managed. Look at the resilience this asset class offers when it's stress-tested. During the initial shock of the COVID-19 pandemic, direct lending funds saw losses of only 1.1%. That's half the rate experienced by high-yield bonds, which lost 2.2%. That shows superior downside protection achieved through active management and precise loan structuring.
Okay. That's a compelling argument regarding historical resilience. I'll grant you that point on COVID. But have you considered the cost and the structural difficulty for middle market retirees to actually access that superior protection? You're kind of glossing over a critical problem here: the fees. Closed-end private credit funds typically charge high management fees, maybe 1.5% to 2.0% annually, plus performance fees, often reaching 20% above some benchmark.
These high costs severely erode the benefit for someone with, say, a $200,000 IRA. The superior performance you cite, that 9.3% annualized return, is often significantly reduced once those institutional-level costs are applied to a retail product. It's not the same net return.
But even net of fees, the performance still blows away the alternative. Furthermore, that resilience isn't just theoretical. Consider 2022. Investment-grade corporate bonds lost 19% as the Fed hiked rates. 19%. Private credit funds, largely due to their floating rate structure, returned 8.5%. Floating rates mean as the central bank raised rates, the interest payments on those loans adjusted upward. That provides a natural, immediate hedge against inflation and rising rates. You cannot seriously argue that taking an 8.5% return in a hostile rate environment is worse than a 19% loss just to maintain liquidity in what is clearly a failing asset class.
I agree that the floating rate feature is a powerful defensive tool. I absolutely do. But let's shift focus slightly to diversification and the concept of suitability, because this debate is about alternatives broadly, including hard assets, right? You keep pointing to what the ultra-wealthy and institutions are doing, allocating 15 to 20% to private credit and central banks hoarding gold. Why are they doing this? They are hedging against the structural risk of fiat currency depreciation and inflation, which are exacerbated by the massive deficit spending you rightly mentioned earlier.
Precisely. And that's my point. If you have substantial savings, let's say $100,000 or more in an IRA, you need to diversify away from purely paper assets. This isn't just about private credit, it's about acknowledging the global move toward hard assets. If central banks are signaling the end of dollar hegemony by hoarding gold at record rates, why are average retirees still sitting there, maybe 95% exposed to U.S. government debt and equities? We must follow the sophisticated money. But here is the hurdle, and this is why timing matters so much with portfolio protection. Most people with $100K, $200K, $500K in their IRAs or 401Ks, they understand that they should consider integrating hard assets like gold. They see what central banks are doing, they read the headlines, but they keep putting it off because they don't understand the mechanics of how to actually move those assets into a tax-advantaged account. The mechanics, the process, the real costs, it's often a complete mystery, right? That's exactly why we put together a comprehensive free gold IRA guide. It's linked right there in the description. It breaks down the entire process with zero pressure, just facts. How rollovers actually work, what the real costs are, and the 3 simple steps to get started, which honestly only takes about 15 minutes once you have the info. If you've got at least $100K sitting in an IRA, 401K, or other retirement accounts, this guide will show you exactly how the wealthy are positioning themselves right now.
Okay, I appreciate you offering a practical solution to the execution problem. That's helpful. But let's return to the underlying data for diversification benefits, whether we're talking gold or private credit. Private credit statistically exhibits a negative correlation of only negative 0.02 with investment-grade bonds. That, statistically, is the diversification benefit. It moves independently of the public markets, more or less.
Right.
However, when you talk about those superior recovery rates, that 68% recovery rate versus, 33.7% for high-yield bonds, that stems from sophisticated covenant design and active workout management. Now, covenant design, for our listeners, these are the specific legal protections built into the loan agreement that help lenders recover capital when a borrower defaults. These capabilities, this active management, it's completely inaccessible to the individual investor. You are buying a black box, essentially, hoping the manager's team is smart enough and diligent enough to protect your principal.
But that risk is actively managed, whereas the sovereign debt risk you are implicitly embracing by sticking to treasuries is unmanaged, and it's systemic.
Wait, hold on. I must challenge the premise that sovereign debt risk is inherently higher than the credit risk for a single non-investment grade borrower. You seem overly focused on duration, and you're downplaying the true nature of the credit risk here. Private credit is fundamentally debt to middle-market companies, often non-investment grade. For retail investors accessing this through, say, feeder funds or BDCs, they are relying entirely on the manager's due diligence and proprietary deal flow. That black box means the suitability rule is arguably violated. A retiree cannot possibly perform a 6-week due diligence cycle on some struggling restaurant chain or a manufacturing plant hidden somewhere in that portfolio. They just can't.
I'm still not convinced by that line of reasoning, because sophisticated investors are actively taking on this specific credit risk precisely because the risk of structural government debt failure is higher and it's more pervasive. Look, when the Congressional Budget Office projects annual deficits reaching $2.8 trillion by 2034, that systemic fiscal pressure is a far greater long-term threat to fixed assets than the short-term cyclical credit risk managed by experienced private credit teams whose historical average loss rate is minimal. It's around 1.03%. The risk of doing nothing, of keeping all your exposure tied to a structurally failing public bond market, is mathematically greater. You are advocating that retirees accept a guaranteed long-term inflation tax and potential capital destruction just for the perceived benefit of instant liquidity.
That guaranteed liquidity is what allows a retiree to weather a medical crisis or a sudden need for capital without selling assets at a loss. You can't just dismiss that. And you also cannot ignore that the illiquidity premium, that extra yield you receive for locking up your money, it's shrinking. The market has exploded from, $750 billion in 2018 to nearly $2 trillion in 2024. That increased competition is driving down spreads, meaning the compensation for locking up your money is diminishing, while the lack of liquidity remains absolute. That trade-off is getting worse.
The illiquidity premium still exists, and it aligns perfectly with the 20 to 30-year retirement horizon many individuals face. Look, we have established that the 40-year bond trend is structurally broken. The risk of inaction, of watching your portfolio potentially crumble under the weight of fiscal irresponsibility, is profound. Retirees must shed the complacency of traditional fixed income and adopt the diversification strategies used by institutions. Whether that's utilizing the superior performance and resilience of private credit or integrating hard assets to hedge against currency and inflation risk, action must be taken now.
The reality, though, remains that private credit, while compelling through large institutional mandates, is complex, it's high fee, and it is fundamentally illiquid. We must acknowledge that for the typical retiree, maintaining manageable duration risk in public markets, perhaps by focusing on short-term bonds and accepting those lower yields, may well be a safer, more transparent, and ultimately more suitable path than entering highly specialized, high-fee structures where they have absolutely no visibility into the underlying credit risk or the specialized workout capabilities that justify those superior recovery rates you mentioned. However, I think this debate absolutely confirms the critical necessity of every retiree understanding duration risk and the limitations of traditional fixed income in this new, more volatile environment. That much is clear.
Indeed. And this macro shift affects every single asset class. There's much more to explore within the material regarding how these new systemic risks, everything from fiscal pressures to de-dollarization, are reshaping what a truly defensive portfolio looks like, especially when we consider tactical allocations in the year ahead.